And so this is one of the most difficult things, I think, for people to kind of get their head wrapped around, is that these prices are fair. And to expand on that, it goes back to Fama's Nobel Prize, which basically said these prices include all available information and forecasts. So I actually went to the Nobel Prize website, nobelprize.org, you can see here. And here's the explanation of why Fama, his work that resulted in him getting this Nobel Prize. And I love the way they wrote this. For many of us, or he wrote it, not sure, the rise and fall of stock prices symbolizes economic development. We had a lot of questions around this idea. What happens if we have a recession, or what's going to happen if, we have a war in the Middle East, all of these economic developments. In the 60s, way back in the 60s, Fama demonstrated that stock price movements, stock prices, are impossible. I mean, that is such a strong word. Impossible to predict in the short term, and that new information affects the prices almost immediately. Now, they talk about the randomness of these returns. You want to think of this new information as being something that's random, okay? Because we don't know what it is. It's new. It's not old information. It's news, not olds, I like to say. And it happens almost immediately. The price adjusts to that. In other words, if you're reading me yesterday's newspaper, forget about it. That's already been impacted, already embedded into the price. And that is, in essence, what market efficiency means, and that the market is efficient. I think I even heard Fama say one time that efficient, he kind of regretted even choosing that word. It's a little confusing to people, but you want to think about of this processing machine that Apollo mentioned, is that it's a very efficient way to take all this information and forecasts of all these buyers and sellers and basically accumulating them together to bring about this fair price. And it's done in a very efficient way. Millions of trades every moment, okay, by millions of people all around the world watching and accessing pretty much the same information. Or, as you just talked about, now you have the computers accumulating this information. And ironically, not all of them say to buy. Some of them say to sell based on one algorithm, and some say to buy. And so I also like the last line here: the impact of Fama's results has extended beyond the field of research. For example, Fama's results resulted in the development of index funds, but even more importantly, the development of dimensional funds, because this is the first half of the reason he got his Nobel Prize. Prices are right, markets are efficient, prices move in a random fashion. That's all around market efficiency. But then he also said, if you just bought the total market, the Russell 1000 or the MSCI World Market Index, something like that, that's a good starting point. But then he identified some risk characteristics. We call them risk factors. You might think of a risk factor as something that might influence whether you're going to get a heart attack or not. That's what a physician calls a risk factor, right, Apollo? He's identified some risk factors that go a little further in explaining the differences in returns, okay? So important. And so now, if you look at this other component of Fama's prize, and listen, this is why my book has step 2 Nobel laureates. I couldn't believe what a mind-blowing realization it was when I realized that these people were getting Nobel Prizes for things that really helped investors, and that we should really be reading their academic papers instead of Barron's and the Wall Street Journal and sitting watching Jim Cramer talking on CNBC. So anyways, this is the second component of Fama's prize, which basically explain these differences in returns among in this case, really 3 different characteristics or risk factors for equities. This is just for the equity side. So the first one had to do with size. And this data is limited to the 1963 period, because to get profitability data, we have to dig into the balance sheet and look at gross profits and assets. And that data is not easy to come by prior to 1963. In fact, I'm shocked they were able to go back that far, Apollo. Anyway, you can see here in this period, just if I look at size alone, large companies have earned 10% and small companies have earned 11%. I want you to think a minute about the inverse of that. This is the cost of capital. The shareholders of those small companies had to give up their shares to get cash. And the return that they forego by allowing that stock to be transferred to somebody else in order to get their capital, that's capitalism, by the way, was 11%. But the large companies, it only cost them 10% to give up their shares in order to get cash. That's another kind of mind bender for people, that the cost of capital for the firm and its shareholders is the expected return for the buyer of those shares or those investors. So now let's look at value factor relative to growth. So this is kind of cool, this new little breakout. You can see it among large companies and among small companies. So here you can see sort of dimensional specialty, and Fama's specialty really was the identification here that small and value companies have had the highest returns among growth, and even large value. If you look at this little quadrant, you can see that this is the highest number. And now the latest one, thanks in part to Robert Novi Marx, who really crystallized this, although Fama, I understand, had done some previous work on profitability. And you can see here that also, if we add profitability to small, we have the highest returns here of 12.58, where low profitability large, think of that as kind of the opposite here, was only 9.15. So these differences in characteristics of companies allow investors to sort of stretch out on the risk scale. There's greater risks here to take these on and improve their returns a little bit. We're only going for maybe a couple percent on average per year. If you stretch this out into small and value and profitability, and you get different sort of exposures to these, you don't get all of these numbers because you're not 100% any one of these, right? But if you stretch this thing out, you can see the historical return was higher. And because you have a large sample here, you can be fairly confident, how's that for a compliance phrase, that in the future, over long periods of time, and there's not certainty in you getting these returns every year, that you are likely to see a small increase over a market portfolio. Now, it's not easy to get these because there's long periods where they don't occur. That's the randomness of these returns. And so anyway, I always like to review this Nobel Prize winning research that really reinvented, starting really with the beginning of dimensional, this sort of passive indexing approach to focus on what I like to call a custom index, which is really an index tied to this academic research. Research indexes, they're often called, come from these professors who work 7 days a week, 24 hours a day, I think Fama works.